Hi, I'm Elliot from Free Life Financial, and today I'd like to explain mortgages in 3 minutes. If this is your first time watching, then please feel free to like and subscribe, clicking the subscribe button below. A mortgage is a loan that you take out to purchase a property. You'll usually only be able to borrow up to 95% of the purchase price, meaning the other 5% is your deposit. So if you purchase a property for £100,000 on a 95% mortgage, then that means you borrow 95%, which would be £95,000, and you would put down the other 5% as your deposit, which is £5,000. Generally speaking, the bigger deposit you put down, the lower your interest rate will be. Your likelihood of being accepted for a mortgage depends on lots of different variables, but just some examples are your income, your type of employment, your credit history, and the size of your deposit, but of course also loads more. You'll choose a mortgage term. The mortgage term is how long you take the mortgage over. Taking a longer term spreads the payments out, which means the monthly payments would be smaller. You'll also choose what type of mortgage deal you want. A lot of people choose a fixed term mortgage, which means that for a certain number of years, for example 2 years or 5 years, your interest rate is guaranteed to stay the same, which means your monthly payment will be the same every month. Often, however, with a fixed term, you'll be tied in, which means that you'd have to pay a fee if you wanted to repay your mortgage in full during the fixed term period. This could create an issue if you wanted to move home or if you wanted to sell your home and repay the mortgage in full during a fixed term. The fee is usually a percentage of what you owe, so it could be a lot. After the end of your fixed term, your interest rate could change, so that's when it's time to review your options. You might choose to take another fixed term with your current lender, or you might decide to switch to another lender who has a cheaper deal, and that's what we call a remortgage. At this point, you can also reduce or increase your term. So for example, you might have a 20-year term and want to reduce it to 15, which would probably mean increasing your monthly payments. The end of your fixed term can also usually be a good time to move home if you're thinking of moving, because you won't be tied into your current deal anymore. So what happens when you move home? Well, you'll sell your home and you'll use the money from the sale of your home to repay your mortgage. You'll then apply for a new mortgage for a new home. It sounds a little bit complicated, but don't worry, you'll have a solicitor who'll take care of all of the complicated parts, and usually they'll be able to make sure that you can move out of your home and move into your new home on the same day. If you want to move home during a fixed term, sometimes you'll have the option of taking your current mortgage deal with you to another property, which is called porting, and sometimes that can mean you can avoid paying the fee to come out of your fixed term early. I will explain porting in more depth in another video. Eventually, you'll come to the end of your mortgage term, and as long as you've been making all of your monthly payments, you'll then own the property mortgage free. And that's mortgages explained in 3 minutes. Of course, mortgages are quite complex. There's a lot more to it than this. So if you would like a more detailed explanation of how things work, then please get in touch using the contact details below. Thank you.